In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Merrill Chandler here, your host of the Get Fundable podcast and your guide to the Get Fundable universe. In this episode, guys, first of all, it started out as a news update that we do. And if you aren't aware, join us on our Facebook page, Get Fundable Facebook page, on Tuesdays at 12:30 Mountain Time, where we do all these great industry updates, what's going on with lenders, banks, etc. Anyway, so what we talk about in this episode has such high impact over the next at least 5 years in the trends where borrowing is going. So there's some crazy things that I talk about. So make sure you listen to this episode. Perfect example. One of the things we talk about is the trend towards contactless or digital wallet, using Apple Pay, your Apple Watch, Google Wallet, all those things, right? But the prediction based on the current trend is that by 2025, there will be $10 trillion a year using contactless digital wallet technology, where it's 5.5 in 2020. That's a doubling over the course of 5 years. That is an unheard of transformation in the technological modalities that are being implemented in purchasing. So do not miss this episode, you guys. When we come back, we're going to go through these 5 major trends that are it's going to shake you to the foundation, and it is cool as hell. I'll see you on the inside. Welcome, everybody. Merrill Chandler here, your host and guide to the Get Fundable universe. This is our Tuesday update. Now, we're doing this weekly, and I know it seems like I say this, but things are moving so fast out there in the marketplace. All of the sources, all of the trade rags, all the lender updates, the underwriting companies, all the intel that kind of accumulates in my inbox and the seminars that I attend. It's like a major player or several major players every week are announcing something new. And so today, just like the title says, there are 5 major trends that are very cool, but if not navigated well, are going to ruin a borrower's fundability. So I'm going to go through these specifically and cover each one. But there's some cool stuff that's coming that isn't going to ruin fundability. It's actually going to enhance it and give people so many more opportunities, right? So let's hit this. Number 1, there are new credit options that are coming out. First of all, Apple Pay came out years ago, right? You just hold your wallet up and there's what they call token transactions, right? So instead, if you know Apple Pay, Google Pay, any of them, they don't use your personal credit card. They use a token that translates your 16-digit credit card number into a different number that's recognized in the system and reduces fraud. Well, there are way more of these types of processes and the banks that are onboarding this. One of them is just released is JP Morgan Chase is actually entering. It's preparing its first new credit option, like lending people money to the invisible marketplace that we've been talking about now for over a year. These 50 million invisible potential borrowers. A month ago or so, we talked about what some of the big banks Wells Fargo, Chase, and Bank of America were told the administration that they're willing to do this and willing to play this game and offer up their data to this national credit registry that Biden proposed. Well, right now, I guess they're racing to the market because now J.P. Morgan Chase is offering a credit instrument to these what are also known as unbanked or underbanked borrowers, right? And so these evolving forms of credit that Chase is proposing is going to be work from payment histories other than credit instruments. So we've talked about leases, utilities, cell phones, et cetera, as well as bank balances. Now, if you've been to my boot camp, we talk hugely about the 1-2-4-7 model. And if you don't know what we're talking about, we can't cover it here. Go to Get Fundable Boot Camp and come and join us, because they're literally using bank balances to drive new credit instruments, right? Chase is first to off the mark here, but I'm telling you, it's coming. So this 1-2-4-7 model is worth it just to find out what that means if you haven't been to the boot camp. If you have been to the boot camp, holy hell, did we call it? I mean, we've been talking about this for over a year now, the 1-2-4-7 model, and now credit banks and lenders are using these 1-2-4-7 modelings to actually all by itself give the unbanked, these invisible borrowers, the opportunity to establish credit with the banks. All right. So number one, new credit options are coming out, both driving this the potential borrower marketplace. 50 million borrowers are going to be coming into the markets, you guys, and that's amazing for our economy. It's amazing for retailers, and it's amazing for the unbankable. It's amazing for the invisibles, because until now, the only access they have are to high interest predatory lenders, the help you the rent to owns and the check guarantee or the check cashing places at 36% interest per week. I mean, it's a freaking nightmare out there. And now the big banks are moving to support this marketplace, and it's just going to be a boon for everybody involved, especially those who have been unbankable until now. Now, the second thing is what's being called the rise of buy now, pay later, BNPL. Buy now, pay later. Now, that sounds like, well, traditional credit is buy now, pay later. But why it's becoming its own kind of brand, why it's its own acronym, is because the buy now, pay later, there are, remember how we talk about credit card processors, and there's Visa and MasterCard and Discover and American Express are all processors, right? Well, there's a kind of a new group of processors coming on board that by the name of Klarna, Affirm, Afterpay. Afterpay is being acquired by Square, by the way, because it's coming so fast and furious that these buy now, pay later processors, it's interest free. So go way back into your days where you go to the if you've ever gone to a furniture store, a mattress store, they say buy now, pay later. That's where that's where this language is coming from. Where, hey, 90 days, same as cash. 365 days, same as cash, meaning that merchants, to try and compete for even the terms are getting fuzzy. We call it the credit space, but that's why they're calling it buy now, pay later. More and more of these processors, Klarna, Affirm, Afterpay, et cetera, are saying we will carry the paper interest-free at traditional retailers. Not furniture and mattress stores, et cetera, but traditional retailers. So be on the lookout. We'll be talking about this I'm sure over the next months and years, but just watch for these other processors, because you may be able to pay for things without interest, and that buy now, pay later is growing. It is Visa. even Visa as a processor is opening up an interest-free payment installment plan. So it's just like straight out of the old days. I've been shaming the buy now, pay later group because they'd put it on a revolving account, right? So in buy now, pay later, some of these are revolving, some of them are term. Notice where it says interest-free payment installment plan, that still falls within our fundability model. But if the buy now, pay later model is a revolving, then it's going to be a tier 4 junk card. Don't do it. So we still got to operate by the rules of fundability. The higher the tier, the better the offering. But this offering from Visa is an interest-free payment from as an installment loan. We love it. We will we'll sign off on that one. All right. Number 3 of the 5 new types of rewards. Now this is awesome. This is awesome. First of all, the Apple Card kind of broke new ground. Apple Card said, "Oh, you can have the Apple Card, but if you just have the Apple Card on your phone and where you wave it past the little insignia that looks like a radar or whatever, you wave it past that and pay for it." Apple's delivering back to the app custom rewards daily. I mean, literally on the purchase. The second you do a purchase, whatever it is, 1% back, 2%, free miles, whatever it is, they are delivering those for in-app use on the same day. Now, Apple's kind of innovated that, but it's going way beyond that. Crypto rewards are starting to grow. We've been talking about crypto for a while. So there are certain rewards that are being done in crypto, and there are and interestingly enough, people are moving more and more to gamification, so that you're actually they're incentivizing the purchase for you to hit custom rewards. Like if you want to go to Hawaii on a flight on Southwest or Delta, doesn't matter, then they're data mining to see who's doing what and where. Like I have a Southwest card. Let's use this as an example. I have a Southwest business card. So every time I purchase a plane ticket on Southwest, I get mad points. I get all these benefits and offerings. The example would be that they're gamifying it for me to say, pick a destination that I want to go to, and then it keeps reminding me you're only 2,600 points from your Hawaii trip. You're only 1,400 points from your Hawaii trip. And they're starting to offer custom perks based on your data mining. So that's all of that when it comes to fundability. Good news, as long as I'm using my Southwest business card, which doesn't report to my personal profile, rather than use a lower value personal card. But if you're a savvy borrower instead of a business borrower, then there's a whole different strategy, and we'll have more on that in later updates. Just know that they're offering all kinds of customer-focused, customer-customized, so borrower customized rewards, incentives, and gamification to get you there. So it's awesome. It's awesome. And it's literally like the gold rush. Everybody's screaming into this space. Now, I started talking a little bit earlier about tokens. They're using tokens now. They're using the app and or like the Apple Watch or other devices that are going to allow you to purchase using the token. You're not even have to pull out your damn credit card anymore. Some people already use this, but they don't want the credit card in play. They don't want the 16 digits in play. So lenders are pushing heavily on how to use that little radar token that is Apple Pay, Google Pay, etc., and use your watch for your purchases using those tokens. I have a number here. Visa transaction data said tokens reduce fraud by 26% compared to regular online transactions when you use your traditional 16-digit number from your credit card. Dude, that's another 26% reduction in fraud just by using tokens. All right. Now, here's the last one, number 5. The research is calling it creative segmentation. But what it is just like they're customizing and gamifying bonuses for you based on your borrower behaviors. All right. They're also giving you a choice of how they're customizing rewards for groups you associate with. Perfect example, there's a Daylight is catering to the LGBTQ plus community, offering cashback rewards for going to LGBTQ plus allied businesses. So there's target groups, students, immigrants with individual featured and rewards based on that. Then there are what I like to call vanity instruments, but there's one for a luxury card that glows in the dark, and the luxury card's being issued a titanium MasterCard that's actually promoting how heavy it is, because since everybody's going to this, sometimes you just want to pull out a chunk of metal instead of a plastic card. So they're customizing everything. Google Wallet, Apple Pay, everybody's customizing to the borrower. Now, we've been talking about borrower behaviors for years, right? The rest of the world hasn't been talking about borrower behaviors, but now that we have literally a decade's worth of borrower behavior and trended data, everybody's using this trended data to start making customized offerings to you. Now, as long as we follow the rules of fundability, as long as we look for, we have to, first of all, we have to know, are we a savvy borrower or are we a business borrower? Because there's 2 different optimization paths for each one of those. If you're a business borrower, then that's what the boot camp second day is all about, et cetera. If you're a savvy borrower, then we want to highest possible rewards and lowest possible interest costs. Both of those you can find here. My name is Merrill Chandler. It's been my pleasure to give you this update. This stuff is so much fun to just stay up with. And you get it here, Tuesdays, noon 30, Mountain Time. I'm Merrill Chandler, your guide to the Get Fundable universe. Please like, comment, share. This is cool stuff. Make sure that you're giving this to your friends, family, associates, people who need to know and stay in tune with what's going on out there. So love you guys. I will see you same Fundable time, same Fundable channel next week, Tuesday, noon 30, Mountain.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.